Thank you, Peter. Today I'll be presenting on real estate investment trusts, or REITs, and why we believe they're set up well to deliver attractive yields with real growth potential for the risk-conscious income investor. First off, please note the brief disclaimer on this slide. And of course, very quickly, for those of you who might not be aware, APN Property Group was recently acquired by Dexus, a top 50 listed company and one of Australia's largest commercial landlords and real estate investment managers, with over $45 billion in assets under management across Australia. In terms of the APN real estate securities funds and team, nothing material has changed, with our management of the existing suite of funds continuing as usual and absolutely in line with our property for income philosophy. With APN Property Group and now Dexus, we've continued to broaden out our global REIT investment capability and track record, with each of our funds delivering solid returns since inception, as you can see on this slide. And of course, with the launch more recently of the Global REIT Income Fund, rounding out our product suite very much as a natural extension to Australia and Asia, and performing exceptionally well since its inception over 18 months ago. So in today's presentation, I'll touch on the quite compelling attributes of REITs for income-focused investors. I'll spend a bit of time highlighting some of the most attractive sources of yield and growth we're seeing from two select sectors, being the healthcare and logistics real estate spaces. And I'll also discuss why REITs can provide an excellent source of real income yield and can often provide an attractive inflation hedge given the nature of the asset class. So it's important to appreciate that REITs offer access to real income derived from a very broad range of underlying commercial property types, from traditional office buildings and grocery stores right through to data centers and mobile towers. On our estimates, the global REITs currently offer annual distribution yields ranging from anywhere between 1% to 2% right through to the high single digits, but also with a 3-year distribution growth CAGR across the entire investable universe, ranging from 2 to 3% right through to almost 20% per annum. The earnings prospects for the real estate types available are often underpinned by very different drivers, which can make a selective allocation through an actively managed fund beneficial for maximizing income yield, while also minimizing volatility and setting up prospects to realize comparatively attractive total returns over the longer term. So when many hear about commercial property and REITs, the initial thought is often towards yield, of course, but backed by income derived from the more traditional asset classes like office buildings and shopping centres. As you can see from the graph on this slide, our analysis of the global universe shows those REITs with own healthcare, retail, and diversified portfolios are currently yielding around 4%, and with a distribution growth profile implying around the same amount. Now, of course, from select REITs in these sectors, there's also an ability to find relative value and mispricing to also drive total return, but the yields are relatively attractive. Indeed, those property types are a core component of the sector, but today at around 40% of the global market cap, they're far from the main game in town. As income-focused investors, we're particularly attracted to the relatively high distribution yields on offer from REITs specialising in healthcare real estate. And these are currently ranging from around 4 to 6% in terms of the yield they can provide on current pricing. Also, when we consider the underlying dynamics, it's clear that select parts of the healthcare real estate universe can also pay a sustainable and growing demographic dividend, supported by aging populations across developed markets that will need increasingly high levels of service. So when we break down the healthcare REITs, they're broadly two distinct segments, being the high acuity cure type real estate, and this is hospital campuses, rehab centres, and medical office buildings and life sciences centres for research, but also care portfolios, and they're your skilled nursing facilities, which are essentially aged care and of course assisted living. Now at the moment, we've got a preference for the cure segment of the healthcare market, and These portfolios generally offer investors stronger tenant covenants, longer lease expiries, higher NOI margins, and importantly, built-in inflation protection via fixed or CPI-linked rent increases. The global REIT sector also provides a relatively unique ability to access portfolios offering an exposure to some of the most compelling secular trends in existence across the entire global economy. Real estate in the logistics sector servicing rapid growth in e-commerce, mobile towers providing for the transmission of digital communication, and data centers allowing for its storage are just a selection of these and some of the most compelling. And of course, while the headline distribution yields implied by many of these REITs is relatively low at between 1.5 to 3%, the sector tailwinds underpinning their future prospects imply exceptional growth, as you can see in the middle bar here of almost 10% CAGR over the coming 3-year period on our estimates. We're particularly attracted to REIT portfolios that own logistics properties, as these currently provide access to very strong earnings and distribution growth profiles, albeit with lower headline yields of between 3 to 5%, but in select cases, distributions are growing at well over 10% per annum and indeed almost 20% in select cases. This is essentially due to trends in online retail having accelerated through COVID-19, with penetration rates for online retail brought forward up to 5 years. Also, supply chain resilience and efficiency is a battleground for operators demanding more space and driving rents. These are just two major drivers of outsized tenant demand for logistics space, but also the level of rent tenants are able and willing to pay for the right premises. Indeed, those logistics and 3PL operators that are located in infill metropolitan markets closer to consumers can substantially cut down their delivery and fulfillment costs. And with that offset allows them to pay a much higher level of rent, which on some cases can be anywhere between 5 to 6% of the total operating cost base for these REIT tenants, which can have savings that directly flow through to their capacity to pay rent. So we see that there's a great economic setup there for increased structural rent growth for the right select industrial real estate portfolios. Now on to inflationary pressures, rising interest rates and what this means for the REITs. I guess contrary to many generally held beliefs, REITs are not simply a fixed income security, but a real asset class with some quite compelling inflation hedging properties. This is due to both the income and value underpinnings of real estate, including inflation or fixed annual rental increases and rising construction and labour input prices feeding through to values and development feasibilities, often in favour of existing asset owners. Indeed, the structural characteristics of real estate and real estate securities have absolutely come to the fore of late, despite rising inflation and interest rate expectations. For example, year to date, the Australian REITs have returned over 17% versus around 12% for the S&P ASX 200. All while the Australian government 10-year bond yield has risen 84 basis points to 1.82%. Indeed, A-REITs have continued to outperform equities in the last week, month and quarter, despite increasing expectations for inflation. I guess that concludes my presentation on how the REITs continue to deliver attractive yields with growth opportunities for the risk-conscious income investor. The APN real estate securities funds are absolutely committed to delivering attractive levels of income through our three regionally focused funds, being the A-REIT Fund, Asian REIT Fund, and Global REIT Income Fund. Each fund pays a relatively high monthly distribution, is currently benefiting from the healthy earnings outlook which exists across the REIT universe, and is taking advantage of compelling value opportunities. So thanks again for listening, and I'll now stand by for any Q&A.